Why do 80% of traders, retail traders, lose money? As a hedge fund manager, let me tell you the main reasons. One, L plus L, losers add to losers. They'll add to their losing positions. Professionals, when it comes to trading, I'm not talking about investing. When it comes to trading, professionals don't do that unless it was part of some grand overall scheme strategy to begin with. Secondly, winners add to winners. We tend to add to our winning positions. Why? Well, it allows us to start small in case we get it wrong and we make a loss. We only lose small. But knowing that we're going to add to our winning positions when we've got some profits means we can start smaller. And by adding to those winners, we get a few big wins during the year. 80% of our money comes from just 20% of our trades. It's just how it is. Okay, and we expect to be a bit better than a 50-50 coin, not right 100% of the time. We just don't have a time machine or a crystal ball to be able to do that. VSL, volatility-based stop losses. The more volatile the market, further away the stop loss. Private investors don't do that. VPS, volatility-based position sizing. Further away the stop loss, because the market is more volatile, smaller the position size. Again, retail clients don't do that. So what do retail clients do? They take massive bets, add to their losing positions, and then even if they call it right as we do, fine. When they call it wrong, as they're bound to, as we are as well, they really lose their shirt. When we get it wrong, we don't. Remember, we had a small position. We narrowed it when the markets were more volatile and more likely to go against us. We added to our winners when the times were good. So we, by making a few changes, just do a hell of a lot better than retail clients.